Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, I want to note for the record that today's meeting is open to the public through a live webcast. For anyone watching online, if you would like to view the closed captioning of this meeting, please click on the CC icon located in the lower left corner of the WebEx window. You may also change the layout to one of your choosing by clicking the layout option on the top right side of your screen. Before we proceed with today's agenda, I would like to recognize two groups that have joined us in the filing boardroom today. First, we have nearly 30 individuals from the Go West Credit Union Association, which represents more than 300 credit unions in 6 Western states. I look forward to meeting with you all later today to discuss credit union policy and economic concerns. And second, we welcome almost a dozen participants in the NCUA's executive training program. Like many organizations experiencing a generational transition, we are implementing succession plans to prepare our staff by giving them the skills needed to become better leaders and executives. The next cohort is the largest group of executive trainees we've ever had, and I look forward to watching them grow and learn over the next 18 months. With that, I'll pause here for comments by either the Vice Chairman or Board Member Hood.
Yeah, I just want to second the shout out. Good to see people come to DC and come to these meetings. It gives us a crowd to talk to. We don't always have one here. And also members of our sort of up and coming executive program. I think it's great that we do these things. And it's just good to see star performers recognized and prodded along in their career.
Absolutely.
Great, and good morning, everyone, and welcome. I, too, am delighted to welcome the Go West Association with us today. I've been so fortunate to travel to many of your states during my time on the board, so thank you for your leadership. Thank you for your advocacy. There are so many pressing issues that are taking place in Washington, so I'm delighted that you all are here to make your voices heard. Also, to the next level of leaders here at the agency, welcome. I think I rode the elevator up with many of you this morning, so we're delighted that you're here. You are the future of our agency. As we look at some of our retirements that are on the horizon, you all will be stepping to fill those leadership positions in the days to come, and I want you to know that we want to invest in you to give you the tools and all of the things that you need to have a successful career here with us, because there are 135 million credit union members wanting you to keep their institution safe and sound for them. So with that, welcome all of you.
That concludes our opening announcements, and we will now turn to the agenda. Our first item of business today is the operating fees schedule methodology request for comment. Staff presenting are Melissa Loudon, Deputy Chief Financial Officer, Office of the Chief Financial Officer, and Trey Dameron, Staff Accountant, Office of the Chief Financial Officer. Good morning, Melissa. Good morning, Trey. Please begin whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Trey and I are here to discuss and request the board's approval of the draft notice and request for comment about the methodology used to determine the annual schedule of operating fees billed to federal credit unions. If approved, this document will be published in the Federal Register with a 60-day comment period. The NCUA's annual budget provides the resources required to execute the goals and objectives as outlined in our strategic plan. As established in the Federal Credit Union Act, there are 2 primary resources for the annual budget, one being requisitions from the Share Insurance Fund, which we refer to as the overhead transfer, and 2 being operating fees charged to federal credit unions. Today, we will provide an overview of the current methodology for setting annual operating fees and the proposed modifications. When calculating the annual operating fee requirement, the board adds together the operating budget and the capital budget to determine the total annual budget required for the agency's operations and investments. The overhead transfer is then subtracted from the total annual budget to determine the portion of the budget financed by the operating fee. The board also reduces the operating fee for the estimate of interest income and by other adjustments in order to compute the net level of collections required to finance the agency's programs. Other adjustments made by the board include an estimate of prior years' operating fee collections that are unlikely to be spent and therefore reduce the need for new operating fee collections. The result is the net budget to the operating The net budget, the net budget subject to the operating fee and payable by both natural person and corporate federal credit unions. The natural person federal credit union operating fees are determined by deducting the corporate federal credit union operating fees from the total operating fee requirements. The draft notice proposes no changes to the corporate federal credit union operating fees. The current fee schedule for natural person federal credit unions uses 3 asset tiers. A different assessment rate is applied to each tier, and the threshold for each tier is adjusted annually to reflect the growth of the credit union system. Currently, federal credit unions with 1 million or less in total average assets do not pay an operating fee. There are 2 steps used to determine adjustments to the operating fee schedule for an upcoming year. The first is updating the prior year asset tier thresholds using the computed rate of natural person federal credit union asset growth. The second is updating the prior year assessment rates for each asset tier by determining the average assessment rate adjustment. For the first step, my office works with the Office of the Chief Economist to project federal credit union asset growth rates and adjust tier thresholds to preserve the relationship of the scale to the applicable asset base. After updating the asset tier thresholds, the team calculates the percentage difference between the projected operating fee collections and the operating fee collections required to support the budget to determine the average rate adjustment. This rate adjustment is applied to amend the prior year's assessment rates for each asset tier, either upwards or downwards. If the projected amount of operating fee collections is less than the required budget, then the assessment rates for each asset tier are adjusted upwards. If the projected amount of collections is more than the required budget, then the assessment rates for each asset tier are adjusted downwards. I would now like to turn to Trey, who will discuss the contents of the draft notice and request for comment in more detail.
Thank you, Melissa. Good morning again. In the draft notice, we propose one change to the operating fee methodology, changing the exemption threshold below which federal credit unions are not required to pay the operating fee, and establishing a process to update the exemption threshold in future years by the credit union system annual asset growth. The change in the draft notice clarifies how the NCUA will increase the exemption threshold for purposes of calculating the operating fee. Currently, federal credit unions with reported total average assets of 1 million or less during the 4 preceding calendar quarters are exempt from paying an operating fee. The 1 million exemption threshold was approved in 2012 and has not been adjusted for 11 years. Since then, total assets across federal credit unions have almost doubled. Considering this trend, we are proposing to raise the exemption level for federal credit unions to 2 million to account for this growth in size of the federal credit union system. In subsequent years, we are proposing to adjust the exemption threshold annually by the computed rate of asset growth in the credit union system. This adjustment would be included in the operating fee calculation presented in the annual draft NCUA budget published by the Chief Financial Officer. The NCUA would adjust the exemption threshold by the percentage change in average quarterly assets reported for the credit union system for the most current 4 quarters compared to the previous 4 quarters using the call report data available at the time the NCUA budget is published. This approach is consistent with maintaining the intent of the board's current policy of exempting its smallest natural person credit unions from paying the operating fee based on those institutions' inability to pay such a fee. The draft notice also includes 2 general questions about how the NCUA charges the operating fee, and we ask that stakeholders provide us their views on these topics. First, we ask stakeholders to provide their views on the current 3-tier operating fee structure, which has not changed since 1993. The current fee structure is regressive. That is, credit unions with a larger amount of total average assets pay a lower marginal rate on those assets above the threshold levels for the lower tiers. Given growth and consolidation in the credit union system, we ask whether stakeholders believe the current approach is an equitable method for allocating the operating fee. We are interested in receiving public comments on whether or how it should consider modifying the operating fee schedule, and what specific aspects of the credit union system it should evaluate when making these decisions. Second, we ask for specific suggestions that would increase the equitable distribution of the operating fee across federal credit unions. Because the operating fee methodology allocates the non-overhead transfer rate portion of the NCUA budget to all federal credit unions subject to it, changes to the methodology do not lower total operating fee collections, but instead shift the fees to those federal credit unions required to pay it. The board is interested in understanding how any proposal to change the methodology could be judged as fair or equitable, not only for those credit unions whose operating fee would decrease, but also those where the operating fee would increase and would therefore bear a greater fee burden compared to others with the current methodology. Thank you for your time. This concludes our presentation. We are happy to answer your questions.
Thank you, Melissa and Trey, for your presentation and for the work of your teams in bringing this proposed notice and comment on the NCUA's operating fee methodology before the board. And Trey, this was your initial appearance at the NCUA board table, as I understand.
It is.
You knocked it out of the park.
Appreciate it. Thank you.
When the board last considered the operating fee methodology in late 2020, we approved changes to account for pandemic response and relief programs like the Small Business Administration's Paycheck Protection Program and other federal stimulus programs that resulted in large inflows of deposits into credit unions. With today's notice and request for comment, the NCUA is once again considering ways to change the methodology used to calculate the assessments charged to federal credit unions to fund the agency's operations. Specifically, the document before us proposes to increase the threshold below which federal credit unions are exempt from paying an operating fee. Raising the threshold from the existing $1 million to the proposed $2 million would increase the number of federal credit unions eligible for the exemption from 128 to 225 respectively. Additionally, the proposal would allow the NCUA to annually adjust the exemption threshold for inflation. Under this proposal, the NCUA board is trying to balance the resources the agency needs to operate and carry out its mission while ensuring equity across federal and state chartered credit unions and the industry's various asset classes. In reaching these decisions, we must further recognize that the credit union system is vastly different from when the three-tiered system was first created. As of the first quarter of 2023, most credit unions have more than $10 million in assets. That was not the case in the past. In fact, at the time we implemented the current operating fee methodology in 2013, there were only 2,181 credit unions with less than $10 million. Today, there are only 950 credit unions with less than $10 million. Like a decade ago, small credit unions are still often the only federally insured depository institutions in under-resourced communities, and they are frequently challenged by economies of scale, increased technological demands, changing consumer behaviors, and a growing competition. Raising the operating fee exemption threshold to $2 million and indexing that threshold for inflation will provide a measure of relief to those institutions, bringing the threshold back into alignment with where it was and keeping it there going forward. That's a good and welcome change. And because we should consider other changes to the operating fee methodology, the request for comment seeks views about whether and how the board should modify the current three-tier schedule. In these deliberations, I'm most interested in softening the regressive nature of the current operating fee methodology. Today, we have 178 federal credit unions with more than $1 billion in assets. Because these larger credit unions pose greater risks for the Share Insurance Fund, we spend more time examining and supervising these institutions. And we know that these large institutions generally have higher returns on average assets than credit unions below the $1 billion threshold. Yet, the current operating fee methodology is regressive in that credit unions with greater assets generally pay a lower marginal rate than credit unions with fewer assets. Why should credit unions with greater assets, greater earnings, and greater supervision pay a lower marginal rate than credit unions below $1 billion in assets, which are more likely to struggle with earnings. The NCUA is authorized to set the operating fee, quote, at a rate consistent with a credit union's ability to pay, unquote. So we do have some flexibility to revise the operating fee methodology to make it less regressive or perhaps even progressive. As such, I strongly encourage federal credit unions to share their views about whether to modify the rate structure of the operating fee schedule to make it less regressive. Given the industry's changing dynamics, I'd also like to know what other changes stakeholders would like the board to consider for future modifications of the operating fee methodology. Thank you again, Melissa and Trey. I have no questions for you, but I do look forward to the request for comment going forward. And with that, I will turn it over to the Vice Chairman.
Thank you, Mr. Chairman, and thanks for Melissa and Trey for the presentation. Nice job, first time. But listen, you're not done yet. Just to review, since 2012, federal credit unions with assets of over $1 million were exempt from the operating fee. And over the last 11 years since that time, assets have doubled on average. Raising the fee exemption from $1 million to $2 million in average assets makes sense. I especially appreciate the proposal to exclude certain assets from the base used to compute the operating fees. So currently, today, the fee charged to a federal credit union, if you have $1 under $1 million, is zero. Get $2 in assets and you pay $164. That's a marginal tax rate of like 6,000%. So the new methodology, where we just take that million and then the 2 million out, put it off to the side, that's akin, I think, to the standard deduction in the tax code, right? Everybody gets a certain amount of tax-free income, put that aside, and then we only start talking about taxes on a number above that. So I think that not only raising it 1 million to 2 million, but doing it in a more sensible ideology where $2 in assets costs you $164, that didn't make any sense. In my over 2 years on this board, I've been struck by the burden on small credit unions to keep their doors open, often with a single-digit number of employees. The burden is a death from 1,000 cuts. There's no one thing. There's no magic bullet we can do. It's not the small fee. It's all the little fees you pay to lots of people, not just NCUA. It's not the single one-page form for this compliance. It's all the one-page forms. These are all reasons people don't want to run small credit unions. The proposed methodology to exclude certain assets, that standard deduction, it's a move in the right direction. We got to start somewhere. The goal here isn't just to cut down on payments to NCUA. It's to cut down on someone's to-do list. It's to cut down on stress. It's one more thing they don't have to think about. Can you just walk me through how does the process for payment for operating fee work, right? Let's say somebody goes about 2 million, or nowadays over $1 million. Do you get an invoice in the mail? Do you get an email? Like, how does it work? How do you pay it? How do you know you have to pay?
So I'm happy to take that question, Vice Chair.
Please speak into the mic.
Oh, yeah, I'll lean forward, sorry. Right. So we do send a paper invoice to credit unions each year. The invoice goes out around March 15th, and it has a due date for around April 15th. That would be give and take a few days if weekends, holidays, so it's about a 30-day time frame. They also have access to an online calculator where they can go in and see what their operating fee would be, and then you can just plug that in online. And in addition, we do encourage credit unions to register with us for electronic payments. And under that process, on the due date for the operating fee, the funds will be automatically pulled from their accounts. And the last thing to add would be that there is a letter to credit unions that goes out signed by the chairman to describe to them the operating fees for that given year. And then once the invoices are distributed, we do put a message on ncua.gov letting them know that the invoice were distributed and the details of the due dates and logistics and information, points of contact they can call.
So when you say sign up for electronic, that's an auto debit where you put your, bank account information. When you say that's the part that's
Yes.
electronic, the debiting of the info, right?
Yes, it's
But in terms of informing folks, hey, you owe some money on a certain date, here's how much, that is still paper envelope via the U.S. mail?
yes, it's a paper
Okay.
invoice.
I would like to look at some way to automate to emails or something like that. I don't want to add more work for us either, but there's got to be some way to just bounce it out, since we have all the data, right? Just auto-generate, send that out. I don't want it to be like, if you remember the stimulus checks in 2020, 88 million were sent via the U.S. mail, paper mail, to addresses that by definition were over 2 years old, right? Okay, and what if somebody doesn't owe anything? Is there a notification, you're all good? You don't owe anything? Or they just don't get an invoice?
So each year we do a combination of a statement that includes the capital deposit, the 1% capital deposit for our credit union, and the operating fee combined on an invoice. So in those circumstances, even if a credit union had less than $1 million in assets, they would have likely had a shift in insured shares up or down, which meant that they would either be getting a small refund back or owe additional for an increase in insured shares. So that would be combined on the statement that they would receive. If they did not owe anything, they owe no paperwork back to us, no notice, no nothing at all.
So if they owe nothing, do they get a piece of paper in the mail that says you owe nothing? Or do they just supposed to know they don't know anything? I mean, it's a good problem to have, but do they, I'd want to know, because sometimes by March 15, you may have gone over the threshold. However, they're not familiar necessarily with our methodology. Why would they be? That we're basing on the prior quarters, right? You might be sitting there today at 2.1 million. Oh, I got to pay. No, you don't, because the prior 4 quarters you may not have. Is there any way that the credit union CEO can just say, no, you're good, pay nothing, pencils down?
Okay, yes. So I believe they will receive a statement regardless, and we can verify that for you.
Like the stuff from your health and, sure, this
Yes.
is not a bill, I'd want to be like, oh, make sure I know nothing. Okay, I owe 0. Good, that's done, right? I think it's good to know you also don't have to do anything. All right, and last thing, normally we talk about the overhead transfer rate. That's the big NCUA takes to pay for ourselves. At the same time, we consider the operating fee methodology. That's what we're talking about today. Why aren't we talking about the overhead transfer rate today? When can we expect to talk about that?
Okay, I can take this question. Thank you. We moved ahead with our recommended operating fee change and comment period in order to align with the 2024-2025 budget development timeline. The Office of Examination and Insurance plans to discuss their review of the OTR, and we'll share that with the board, and then they will present that for notice at the end of the year.
Thank you. That concludes my remarks. Back to Chairman Harper.
Thank you so much, Mr. Vice Chairman. Board Member Hood.
Great, thank you, Mr. Chairman, and good morning, and thank you, Melissa and Trey. And Trey, great job with the board meeting, and you and I have another board meeting later today, so one down and one more to go.
Indeed.
Ladies and gentlemen, the item we are considering today for publication in the Federal Register is part of our agency's ongoing commitment to transparency in our budgeting and financial management practices. Funds for NCUA programs come from 2 sources. A portion is paid by federal credit unions and by federally insured state chartered credit unions through transfers from the National Credit Union Share Insurance Fund using the overhead transfer rate. And the rest is paid through operating fees collected from federal credit unions themselves. The document we have before us will provide the public with an explanation of our methodologies for computing the overhead transfer rate and annual operating fees. Additionally, I support the proposed changes that increase the exemption for which a fee is not charged for federal credit unions. In today's action, we're raising the exemption to $2 million, which is up from $1 million. So that means that now a total of 225 credit unions will be exempt. I also like that we're indexing this figure to inflation. I do, however, have a few quick questions. Are there other fees that we as a board use that we should consider in terms of indexing to inflation?
So I can take that question. The operating fee is the fund's primary source of revenue and the most significant fee paid by the federal credit unions. Other fees exist, such as exam fees, fees for exam reports, and insurance conversion fees. These are modest in nature and more based on the cost associated with the specific service or product and the cost it is to the agency. That concludes my response.
Good, that's really helpful, thank you. And I know the chairman talked a little bit about this, and I want to just consider it a little longer. I realize that we're moving the exemption to $2 million, but given that we've often used $10 million for different exemptions, notably the CSUL exemption, I was wondering if we had considered the $10 million at all as a threshold, or if we should perhaps.
I can take that question. We did consider the option of using 10 million as an exemption threshold for the operating fee. In comparing that with the 2 million, we noted that the 2 million threshold would exempt approximately 7% of federal credit unions, while moving to a 10 million exemption threshold would exempt almost 1 in 4 at 23% of federal credit unions. The increase to the 2 million seemed to be more consistent with the initial effect of the 2012 exemption for 1 million, where there was a exemption of slightly less than 8% of federal credit unions.
Great, Trey. Thank you for that. And I just have one final question. This is somewhat shifting gears and notably for the record. How would you compare and contrast our fee structure compared to the FDIC's?
I'll take that question as well. The FDIC's expenses are part of and paid for by their deposit insurance fund, which is funded by the premiums they charge their financial institutions. This is unlike NCUA, where, as pointed out before, the share insurance fund reimburses our operating fund with a portion of our operating expenses with the overhead transfer. The FDIC does not have a separate operating fee. That concludes my response.
Very well, thank you. I have no further questions. And again, I'll be supporting today's proposal.
Thank you.
Can I ask about this?
Yeah, I think the Vice Chairman wants to ask one
Yeah,
more
should have asked
question.
before. You mentioned we sent out thousands of invoices in March. Is there NCUA employees who physically stuff 4,000 something envelopes? Like there's a room somewhere where somebody's sitting there with the paper and putting it in?
Yes, we do. We do have a print shop that we
Does
do.
that strike you as another reason to do digital notification?
Yes, sir.
All right, thank you.
Thank you for that additional question. Thank you for that clarification. Thank you for the insights on the $10 million. Certainly, at least initially, if we were to move over to an automated system, I know of some credit unions that really are still running their books.
I think it'd be just like your brokerage or whatever, you opt in.
Yeah.
You know,
Yeah,
and if
exactly.
you want a paper, you can get it, you know.
And if you also want to have belts and suspenders.
That's right.
With both electronic and snail
Mm-hmm.
mail along the way. Thank you. Vice Chairman Haltman, is there a motion?
Yes, sir. I move that the board approve the operating fee schedule methodology request for comment for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passes 3-0. Thank you both. That concludes our discussion on the operating fee schedule methodology request for comment. The second item on our agenda today is the board briefing on the new charter modernization. Staff presenting Martha Ninachuk, Director, Office of Credit Union Resources and Expansion, and Leilani Stamper, Consumer Access Program Officer, Office of Credit Union Resources and Expansion. Staff available for questions include Sue Ryan, Director of Consumer Access, Office of Credit Union Resources and Expansion, and Ariel Pereira, Senior Staff Attorney, Office of General Counsel. Good morning, everyone. Please begin when you are ready.
Well, good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. Thank you for this opportunity to speak today about our efforts to expand opportunity and access in the credit union system through 2 projects aimed at helping organizing groups launch new credit unions. The first is the modernization of the agency's chartering process itself. The second is a new provisional charter that provides time for fledgling credit unions to raise the capital they need to become a fully operational credit union. Slide 2, please. To guide new charter development, organizers must become familiar with the Federal Credit Union Act, Section 1753, that defines subscribers and the main points of chartering a new credit union. The NCUA regulations, 12 CFR Part 701, Organization and Operation of Federal Credit Unions, and Appendix B, Chartering and Field of Membership Manual, provides guidance and detailed steps to the chartering process. In order to approve the proposed credit union charter, the required application from the organizing group must state the type of charter requested, products and services to be offered, a business and marketing plan, and projections to support the sustainability of the credit union and the NCUA to approve the charter issuance. Slide 3, please. I should note at this time, for those organizing groups seeking a state charter, the charter approval process is through the State Supervisor Authority, also known as the SSA. If an applicant also seeks to have the state chartered credit union federally insured, they will need to submit an insurance application to the NCUA. The NCUA will review the application, including the business and marketing plan for insurability, and will conduct a background and credit review of officials and senior management staff if the SSA does not provide this information. Federal share insurance approval will be contingent upon the applicant obtaining SSA approval of the state charter. Additional information for insuring new state charters is found on the NCUA website under Support Services, Credit Union Resources and Expansion, and New Charters. Slide 4, please. Now I will turn the presentation to the steps taken to modernize the new charter process. When the Office of Credit Union Resources and Expansion, known as CURE, was established through the NCUA's reorganization in 2018, we created a team dedicated to assist organizing groups seeking to charter a new credit union. In addition, the agency tasked 2 internal programs, the agency's Management Development Program in 2020 and the Access New Charter Work Group in 2021, to focus on identifying improvements to the new charter program. The agency also hired an external independent reviewer who studied the existing process, interviewed staff about inconsistencies and bottlenecks, and pulled in external stakeholders who have worked with organizing groups seeking a federal credit union charter to gain insight as to how to improve the chartering process. The results consisted of making the chartering process more transparent, easier to follow, and more efficient. From these studies, the agency adopted a 3-phase charter application process and published a revised, modernized charter application guide. Slide 5, please. The 3 phases of the credit union process are defined as follows. Phase 1, proof of concept. Organizers will define the credit union's purpose, the field of membership, identify subscribers, select a credit union name, and define capital funding plans. Phase 2 is the charter application. During this phase, the organizers conduct a member survey and analyze the results, analyze market conditions, and develop a mission statement, business plan, products and services offerings, and other information such as pro forma financial statements and plans for operating. It is important to note securing capital is another requirement before moving on to Phase 3. Phase 3 is the final NCUA approval. This is where all NCUA forms need to be completed during this phase. Also during this phase, the Letter of Understanding Agreement, which is an agreement between the NCUA and the credit union that specifies what products and services can be offered, and terms and conditions the credit union must operate within, is signed. Then the group receives their official charter and share insurance coverage. Now a group applying for a federal charter knows it must meet each criterion for the individual phases before moving on to the next. This allows organizers to keep track of where their application stands. There is more predictability and more transparency. Besides improving the overall process, CURE is focusing on customer service and has set a goal of 100 days from receipt of a complete application, which includes the secured capital, to charter issuance. In addition to the new process and chartering guide, staff updated the relevant sections of the NCUA's website to reflect information on the phased approach, including a flow chart and timeline that illustrate the process and on average how much time is necessary to complete each phase. Slide 6, please. For those parts of the application that we have recognized as the most challenging, we have developed templates to assist the organizing groups. A pro forma financial statement projections template, a document with pro forma financial statement projection assumptions, and this is a guide to assist organizers in developing their assumptions which support the pro forma financial statement projections. A sample member survey, a new charter application checklist, a sample commitment letter, and several NCUA and external chartering resources. Slide 7. The following slides provide charts representing the history of new charters from 2018 through 2023. Based on the reconfiguration of staff solely focused on assisting organizing groups, establishing new charters, and improvements made to the chartering process, I can report that in the past 2 years, we can see positive results. Where the agency was typically chartering 1 to 2 new credit unions from 2018, we chartered 4 in both 2021 and 2022 and are on pace to charter the same for this year. Slide 8. We can also report that the number of average days to charter from the time of obtaining a complete application, which includes the required capital, has decreased from 564 days in 2018 to 185 in 2022. I'd also like to point out that from 2018 to 2020, we were operating under a different process for tracking days to completion. However, since implementing a new procedure, CURE has processed applications within or very close to the 180-day goal. Slide 9. Slide 9 displays new charters by minority depository institutions and low-income designations. The 2 federal credit unions chartered in 2023 are neither MDI nor LID, but that is just because they have not yet self-designated or certified or applied for the LID yet, the low-income designation. And note that there were not any individual MDIs chartered, which is why there is not a representative column. Slide 10. Slide 10 reflects the new charter by field of membership type, with community and single common bond requested the most. Slide 11. New charter issuance by state. The stars reflect the location of the credit union. Slide 12. Data during this period includes total new charter applications received during 2018 through 2023 period equals 29. There were 14 approved and issued a charter. 13 of those are still operational with assets from $500,000 to $6.6 million. The application still in process, which would be phase 2 completing the application and seeking capital, equals 5. Number of denials during this period are 2, and the number of withdrawals is 1. This data supports NCUA's review process supports sustainable credit unions. Slide 13. Besides staff and process improvements, CURE also developed an in-house database to assist CURE staff in monitoring organizing groups' progress and management's ability to monitor work assignments and the overall progress of new federal charter issuance. Slide 14. The database tracks all organizing group activities through the 3 phases. In one glance, we can see how many organizing groups are phases 1, 2, and 3, how many are active, how many have completed the separate phases, and how many were declined. Reasons for declines would be the organizing group has not successfully completed a certain portion of the phase. This report also shows where the proposed charters are by state and the status of the goal for reviews to be completed in 180 days. Slide 15. This report shows how many organizing groups are in the 3 phases and the status of each: active, completed, and deferred. The completed groups in phase 1 have not yet provided their information for phase 2, which is the reason behind the difference in the number of 54 in phase 1 and 13 in phase 2. Information can also be broken down by individual organizing group with a transaction history, timeline by transaction, and the current phase of the application. Slide 16. Slide 16 represents the duration of time the chartering process takes by the organizing groups and by CURE staff. The heavier weighted portion of the chart is with the organizing groups due to putting the idea or the concept of the credit union into a written plan. It takes time and sometimes a couple of iterations to finally get the business plan, marketing plan, and pro forma financial statements to interconnect and support that the proposed credit union will be sustainable. As mentioned earlier, CURE has developed tools to assist organizing groups with developing pro forma financial statement projections and assumptions in a sample member survey and other resources. But many times the new charter application review is complete, and the only thing stopping the charter from being brought to issuance is the securing of capital. The NCUA has taken on the issue of capital in the new charter process and has come up with a potential solution for organizing groups. We are ready to pilot a program that may provide a solution for those organizing groups seeking capital. Slide 17. Now, Leilani Stamper, NCUA's Consumer Access Program Officer, will present to you the concept of provisional charters that addresses the capital issue. Leilani?
Thank you, Martha. And good morning,
Good
Chairman
morning.
Harper, Vice Chairman Hopman, and Board Member Hood. I'd like to take a few minutes to discuss the NCUA offering of the provisional charter, which we are hoping to pilot this year. A provisional charter means a stage in the chartering process where the credit union's organizing group becomes a legal entity and is only authorized limited authority until securing required capital. Our current regulatory authority permits NCUA to grant a provisional charter. Organizing groups face the challenge of raising the required donated capital necessary to implement their business plan during the application process. To further complicate matters, often those who provide capital are not willing to make a firm commitment unless an organization has an approved credit union charter. Also, organizers cannot apply for some grants or use subordinate debt options until the charter is issued. However, before granting a federal credit union charter, the NCUA must satisfy that the institution will be viable and that it will provide the needed services to its members. Economic advisability, which is a key factor in determining whether a potential charter will have a reasonable opportunity to succeed, is essential for a credit union charter. We currently require organizing groups to secure all necessary capital before approving the charter. However, traditional sources of startup capital typically need the recipient to be a registered business, putting new organizing groups in a catch-22. They need to secure sufficient funding commitments to obtain a charter, but they need the charter to obtain the commitments. Slide 18, please. To address this, a pilot provisional charter program is being developed. From a high-level perspective, under this program, NCUA could grant an organizing group a charter if all the requiring is finalizing the capital requirements. Under the program, the organizers will provide a capital funding program, agree to a 12-month period to secure their necessary funding commitments, which demonstrates economic advisability. During this time, the subscribers will be allowed to open their initial par value of shares as prescribed in the Federal Credit Union Act. Credit unions seeking CDFI certification may be allowed to fund a small pool of loans to show service activity. No other services will be allowed during the first 12 months to ensure the program does not create any safety or soundness concerns. Once all capital as outlined in their funding plan has been secured, the credit union will be permitted to offer products and services as outlined in their business plan and in their letter of understanding and agreement. This program will give much needed flexibility. As mentioned before, it will not require any regulatory change. Next slide, please. We feel this prudent common sense solution is a program organizing groups. We feel this is a prudent common sense solution to a problem organizing groups face when they are applying for a federal credit union charter, and we look forward to rolling out the pilot program this year. In addition to rolling out the program, we plan to submit a notice for a 60-day comment period to be posted in the Federal Register for outside stakeholders. It has been said that we succeed best when we are helping others succeed. NCUA sees the Provisional Charter Program and our new chartering processes as examples of NCUA advancing its mission of helping credit unions help their members and community to benefit everyone. Next slide, please. That concludes my remarks, and we are happy to take questions.
Thank you so much, Leilani, and thank you, Martha, for your presentation and your efforts to support the creation of new credit unions. I also thank the many members in the Office of Credit Union Resources and Expansion for their work on several important initiatives, including field of membership expansions, small credit union training, credit community development, revolving loan fund grants and loans, and the subject of today's briefing, of course, new charters. Last but not least of all, CURE's work fielding thousands of questions about share insurance in March and April was really above and beyond. So thank you to everyone on the CURE team for a job well done. A core mission of the NCUA is chartering new credit unions. Indeed, new credit unions are vital to maintaining a dynamic financial system, one that is growing, thriving, and meeting the evolving financial needs of our citizens and their communities. On that note, thank you, Vice Chairman Hauptman, for your steadfast leadership on the critical issue of new charters. Your leadership and focus have expedited the chartering process and helped to ensure that more communities and individuals can have their financial needs met through the cooperative financial system. I also want to thank Board Member Hood for his leadership on the issue of promoting greater financial inclusion as a core function of the agency's work. That's closely intertied with the new chartering process. As you noted, Martha, during your presentation, the NCUA has taken several recent steps to modernize and improve the chartering process. CURE has overhauled the Federal Credit Union Charter Application Guide and its supporting documents. The updated material gives organizers a better understanding of the state and federal options available and offers supplemental guidance for states to reference in their interactions with organizers. Instead of applications taking years to be improved, Martha, you and your team have also reduced the time to review and approve a complete application to approximately 130 days from start to finish. That is very commendable. As shown in slide 7, we've also seen this work producing some real results. The number of new charters has increased from just 1 in 2020 to 4 each in 2021 and 2022. And Martha, as you noted, we appear on track to hit that at least 4, but may even exceed that this year with having 13 charter applications in process. While these numbers are by no means reduce the decline in the overall number of credit unions, as the consolidation of credit unions and banks have been at a consistent rate for decades across a variety of economic and regulatory cycles, they are a positive step forward. And also, as you noted, Leilani, we have been exploring how to address the catch-22 of chartering. Which comes first, the capital or the charter? The organizers need the capital to get the charter, but they can't get the charter until they have the capital. This is a chicken and egg dynamic, and it often leaves organizing groups discouraged. To resolve this frustration, the NCUA is working on this pilot on provisional charters. A provisional charter would allow organizing groups to demonstrate the capacity to start a credit union, which would in turn facilitate their efforts to raise needed capital. In this pilot, the NCUA would grant an organizing group a charter if all they require is finalizing their capital requirements. Under the pilot, the organizers would provide a capital funding plan and agree to secure the necessary funding commitments within 12 months. A provisional charter is an excellent solution to the chicken or egg chartering problem, but I know that it is very hard to raise capital, even if you have a charter. So that period for organizing groups to secure funding is the focus of my first question. Martha and Leilani, could that period be extended beyond 1 year if groups are unable to secure the needed capital?
Yes, the period could be extended under certain circumstances, just as the credit union is very close to securing the capital that it's designated in the plan, and they're really close. It can be extended.
And that would be a give and take between the credit union and your office, correct?
It would probably be a good give and take with the region.
Sure.
But
yeah. No, absolutely. You're absolutely right. Once we create the charter, it moves to the region.
Yes.
And certainly, we want to make sure that a credit union can succeed, and we don't want to necessarily shut down a whole bunch of hard work simply because we may be a few weeks away from getting the capital
Correct.
to keep the credit union going. I really appreciate that flexibility. Additionally, I would like to see the team in CURE explore the pooling of capital for starting a new credit unions, like the FDIC's Mission-Driven Bank Fund, launched in 2021. Such a fund in the credit union space could allow organizing groups to more easily obtain the much-needed capital to start new credit unions. Martha, would you and the team in CURE research this option and report back to the board on the feasibility of and recommendations for creating such a fund?
Yes.
Thank you. Finally, on slide 19 of your briefing, you indicate that you plan to roll out the provisional pilot charter for comment before year's end. Will this require any further board action? I get we don't have to change our rules, but will this provisional charter process, putting it out for notice and comment, require board action?
No, the NCUA currently has regulatory authority to implement the provisional and pilot program, and the 60-day notice is just to obtain stakeholder feedback.
Gotcha. Thank you so much for clarifying it. It's important for stakeholders to understand the process and the steps needed to properly implement such a pilot. I stand ready to work with the team in CURE and my fellow board members to make this provisional charter pilot a reality. In sum, the NCUA is making meaningful improvements to its chartering process to bring new and more federal credit unions into the system. In doing so, we are providing more consumers with greater access to safe, fair, and affordable financial products and services within the cooperative model. The chartering of a new credit union is often the culmination of years of high hopes and hard work by organizers. We need to hone our tools and processes to make those dreams come true. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman, and thank you for your kind words. This has been a priority of mine since my very first board meeting in 2020. I even mentioned it 6 months before that during my Senate confirmation hearing, and I know Chairman Harper and Board Member Hood share this commitment. As one of the original solutions for financial inclusion, the formation of a new credit union is the ultimate demonstration of this agency's dedication to financial inclusion. And we know government agencies are often very good at self-congratulation around issues of inclusion. Agencies in general are very good at talking the talk. What you guys are doing, this is walking the walk. If we make it 1 minute harder for an immigrant group or a church, a mosque, a temple to start their own credit union, then we should revisit our talk around financial inclusion. So this is probably one of the happiest moments I've had in, 30 board meetings I've had. I'm fond of saying what's get measured is what gets done. Today's report is a measurement of progress. And as the first report of its kind, it's a baseline for years to come. There's no question, there's been improvements in the last few years. Dividing the chartering process into 3 distinct phases provides some clarity, especially for that lead organizer who has to report to other people, where are we on that? How's the charter going, right? You're making that person's life easier and you're making people a lot more likely to take that role of starting credit union. We put the chartering manual online. That's positive, that's clarity. Our work's not done yet. We're working on the progress here, but the measurement of our success will not be the process. It will be new, stable charters. All of this is with that end goal. As you know, completing a charter can take years. I believe we also must measure the time it takes from initial application to completed application to find out where the organizing groups are having difficulty, where the bumps in the road are. They're not always our fault, not always theirs. Although chartering a credit union is very different than a merger of a credit union, both processes are, complicated, somewhat rightfully. Somehow the agency has made it easy to streamline the difficult merger process, which is a credit union going away. And from the outside looking in, it can appear we're more supportive of merging credit unions than supporting the groups that want to form a new one. So if chartering credit unions is important to us, our process should reflect that. Going forward, we can look at maybe easy to fill out templates, examples of previous successful charter applications, the sort of things that franchise companies provide to people interested in opening up a new Shake Shack or Panera Bread. More good news, as the chairman said, the provisional charter, the chicken and egg problem, it gets to that. The proposed credit union can't get the charter until they have capital. They can't get the capital until they have the charter. Reminds me of those job ads, entry-level position, 10 years experience needed. Our new internal management system is a welcome tool in the process. I want to give a shout out to Nicolette Alcorta and the CURE team for making a dashboard, truly impressive. It gives the board and the CURE team the visibility into the process and at the same time measuring the process. And again, it can also show the potential friction points. We can clarify those issues with additional resources, templates, training. So one question, when do you think we can see the pilot program up and running on the provisional charter?
We should be able to do that within the end of the quarter. of this year, third quarter this year.
So that would be the end of September, right?
Correct.
Okay, that's good stuff. And what about putting a dashboard on our website without the ability to see names of groups, but just people can sort of see what's going on, kind of like we can? Would that be a good idea?
It's something we can definitely discuss and research,
I know
yes.
the FDIC does it and they put the names. I don't think we want to go to that route because of the nature of organizing groups, but just how it goes. Just what we have, how many other people are applying right now? Is this the first time in years we've heard of this? You know, they should know, yeah, other people are going through this. I believe we have sample bylaws and policies available for small credit unions, right? That can be a holdup, a starting one, creating bylaws and all that. That can take a lot of time. But I hesitate to have government example because people often think if it comes from a regulator, that's what you should follow. You know, that can happen.
That's a
But
good point.
are those resources we can provide to credit union groups?
We do. Not only the templates that we provide
Yeah.
online, but we point them to resources through other stakeholders, yes.
All right, gotcha. Last one. Last week, somebody in the credit union world for 30 years posted this on LinkedIn, all right? It's a snippet of a larger post about the chartering process. So I sent you this one ahead of time. How would you guys respond to this? This is a LinkedIn post. The NCUA has made it extremely difficult. Their job is to protect the insurance fund, not to start new credit unions. And it is making it damn near impossible to start one. And the insurance fund is thus nice and safe. And if credit unions go away, CUSOs go away, leagues go away. What are we left with back to the beginning? End quote.
Thank you for this question. I hope with the new charter and provisional charter presentation today, that the industry sees that the NCUA is really making strides to improve its new charter process, increasing the number of resources to assist organizing groups and actually finding solutions for those challenging areas for organizing groups, such as securing donated capital through the provisional charter. NCUA, I mean, actually, our team is so dedicated. I'd like to give a shout out to our staff.
Please do, absolutely.
It's really they're very mission oriented. It's their purpose to get new charters up and running. So that is their focus, our focus as an agency, and we'll continue to support new charter development.
And I like what you did, not just the people going through the process, but checking in on the new ones from the last few years.
Yeah.
We're not just here to issue charters. We want to have sustainable charters.
Correct.
But you said there was 14 last handful of years, 13 are still operating, but that other one that merged, right?
Mm-hmm.
So it wasn't a collapse where we had to write a check for share insurance, right?
Correct.
Okay, so, all 14 of those groups still have their credit union. And if you looked at the size, it was from 500,000 to the biggest of the 14 was 6.5 million, right?
Mm-hmm.
And since our job, the board, our number one, our true north is that we are fiduciaries of the share insurance fund. One of the things I think that is key here is that these are really small risks to the share insurance fund. If all 14 of those went down, do you happen to know, what the average would be? I mean, even if we had to pay out all of the deposits, right, which almost never happens when we have a collapse, but it's a very small amount of money in the grand scheme of things, right?
I would say so,
Yeah.
yes.
Yeah, and it's rare that you actually have to pay, we write a check out of the fund for all the deposits. So one of the reasons I think it's good to do this is, from an insurer perspective, these are low risk. They're small. So they don't represent a lot of money. So that's another reason why I think what you're doing is so terrific. Back to Chairman Harper.
Thank you so much. I agree with you that most of them are small, but every once in a while we get a conversion,
Yes.
which is quite large, and we have to be careful there as well. Board Member Hood.
Great. Thank you, Mr. Chairman, and thank you all for your presentation this morning. I really do appreciate today's board briefing regarding how the NCUA is streamlining the chartering process to encourage de novo or, quite frankly, new credit union charters. In fact, we've brought several new institutions into the system over the last couple of years. I will never forget when I returned to the agency in April of 2019. I think a few weeks later, Martha, you arranged for me to visit the Oda, Missouri Federal
That's right.
Credit Union there in one of the tribal lands there and outside of Oklahoma City. So that was so great. And to my fellow board members, if you have moments to visit some of the newly chartered ones and give them the charters, it's such a proud moment. You all, in a true bipartisan manner, this NCUA board has shown tremendous leadership when it comes to streamlining and working to create more opportunities for credit unions. So I do want to applaud the chairman and the vice chairman for working with me, to all of us, to get this done in unison. It's also critical, you all, that we recognize the great staff work of people like Martha Nanachek. Thank you, and Cure, for your hard work in bringing a lot of today's activities to fruition. Now, I do recognize you all that moving from one new charter year to maybe four, it's not earth-shattering, but it certainly is a step in the right direction. And the new CURE management system for chartering should make an impact here as well. And perhaps most significantly, so too should the provisional charter concept, which we plan to launch by the Q4 of this year. So I can't wait to see that come to fruition. And I certainly want to thank you for the demonstration that we were able to see on yesterday. That was really great. In keeping with the ethos of people helping people, credit unions give a hand up to people of modest means, creating opportunities to build wealth for working families and marginalized communities, and nurturing a strong sense of local control and ownership. Please note that we aren't saying chartering a credit union should be easy, but it certainly shouldn't feel impossible for many of the organizing groups. I'm delighted at the progress we're making to significantly streamline the process of chartering. Just have two quick questions. What's the biggest challenge for getting a credit union charter outside of Capital?
Sue will take that question.
Sure. So the biggest challenges for organizing groups to getting a credit union charter is demonstrating economic advisability. Typically, the biggest hurdle is obtaining sufficient startup capital, followed up by a management team that can develop a business plan with reasonable assumptions, including evidence of member support. As Martha mentioned during her presentation, we have developed tools such as templates and our updated website to assist organizers with some of these challenges.
Great, thank you. And then one follow-up question. I know that this board has really worked to really make the availability of subordinated debt and secondary capital readily available both to our low-income designated credit unions, our complex credit unions, those as defined above 500 million, but also we've made it possible for the newly chartered credit unions to have access to the tool as well. Have any of them used subordinated debt or secondary capital?
I can take that question. No, not at this time. Subordinate debt is only available for chartered credit unions. So that is why we're so excited about the provisional charter, which would allow newly chartered credit unions to have that option to obtain capital to get sub-debt.
Very well, thank you. But those that are newly chartered now in existence, I just hope that they recognize that that is a tool that they can use.
Yes.
I think that that's being discussed when the coordinators talk to them about possible getting of capital. They talk about that option as well.
Splendid, splendid. Thank you. I have no further questions. And again, really excited that we're all here today.
Thank you. You know, I recently attended a conference with a large number of community development credit unions, and I can tell you that there is deep interest out there in chartering groups. And in fact, I got several business cards along the way there. So know that the changes that you're working on have the potential to even take things further along. And I also think it's important to note that the new charters that we're seeing are doing some amazing things. Not only are they attached to a mosque,
Right.
I know of 2 credit unions that way, or a Native American tribe that may be doing something, but they're also, one credit union that's about 10 years old now, is serving people who are in prison and providing them with access to financial services, which solves the problem you've often talked about. Like, how do you leave jail and not, you're the most watched person, you don't have a piece of ID with your name or picture on it.
If there's anyone that you should be certain of their ID, it's the person you locked up for the last 20 years.
I agree.
And they walk out and don't have ID. It's bizarre.
Yeah.
Yeah.
If I could just make one last request for you, as you're doing your outreach to, and talking to groups, I know that state leagues were once heavily involved in the chartering process. Let's work to make sure that we include them in it, because they can also provide resources and support for the chartering group as well.
Absolutely.
Great. Thank you so much. Great to see you again, Sue, Martha, Leilani, and Ariel. That concludes our discussion of the new Charter Modernization Board briefing. The third and final item on our agenda today is Proposed Interpretive Ruling and Policy Statement 13-1, Minority Institutions Preservation Program. Pam Williams, Program Manager, Credit Union Development, Office of Credit Union Resources and Expansion, is the sole presenter.
Gosh.
Good morning, Pam. It is very good to have you back at the board table. Please start when you are ready.
Good morning, Chairman Harper,
Good morning.
Vice Chairman Hartman, Board Member Hood.
Morning.
The Office of Credit Union Resources and Expansion, known as CURE, is asking the NCUA Board to approve proposed amendments to Interpretive Ruling and Policy Statement 13-1, Minority Depository Institution Preservation Program, or MDI program, for a 60-day comment period. First, for some background information. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989, known as FREA, encourages certain federal financial regulators to preserve and promote minority depository institutions, MDIs. Specifically, Section 308 of the FREA identifies several goals to preserve existing and encourage new MDIs. In the year 2010, Congress enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, which in part expanded the FREA provisions related to MDIs to include the NCUA, the Office of the Comptroller of the Currency, and the Federal Reserve Board. In 2015, the NCUA Board approved an interpretive ruling, or IRPS, to establish a minority depository institution preservation program for federally insured credit unions. As of year-end 2022, there were 503 federally insured MDI credit unions located in 35 states, the District of Columbia, Puerto Rico, and the U.S. Virgin Islands. These MDI credit unions served more than 5 million members and had aggregate assets of $64.7 billion. These MDIs made $42.2 billion in loans during 2022, and more than 95% of them met the NCUA standard for a well-capitalized institution. Before summarizing the proposed changes, I'd like to highlight elements of the current MDI preservation program. The Small Credit Union and Minority Depository Institution Support Program was implemented in 2022. Through this program, an MDI may receive support regardless of asset size. The Community Development Revolving Loan Fund became open to MDIs this year, regardless of their low-income designation status. More than 100 courses and webinars are available through the NCUA's learning management system as free online training to MDI boards, staff, and volunteers. MDI Awareness Month was launched this month to help promote the designation to eligible credit unions. And planning is underway for an MDI symposium to be held in the NCUA Central Office in October. This will be the first such in-person MDI event since the MDI Forum the NCUA hosted in 2020. The proposed updates to the MDI IRPS reflect changes to the agency's structure and program features since 2015. Overall, the proposed IRPS clarifies the requirements to receive and maintain the MDI designation and reorganizes and streamlines the policy to improve its readability. A summary of the significant changes include recognizing the transfer of administration of the MDI program to CURE, incorporating recent program initiatives such as the Consulting and Support Program for MDIs, and providing examples of technical assistance an MDI may receive. Simplifying the term community its services as designated in its charter to refer to an MDI's field of membership. Specifying that Asian American includes Native Hawaiian and other Pacific Islander, and that Native American includes American Indian and Alaska Natives. Clarifying that small entity means a small credit union as defined by the NCUA, and clarifying the simplified process for a small credit union to determine it qualifies as an MDI. Referencing guidance, the NCUA provides examination staff who continue to play a significant role in supporting and guiding MDIs under their supervision. explaining the NCUA will review an MDI's designation status during routine evaluations, and adding new subsections such as engagement with MDIs, technical assistance, examination of MDIs, community development revolving loan fund grants and loans, training and education, and the preservation of MDIs. In conclusion, CURE recommends approval of the proposed amendments to this IRPS in order to better reflect the current MDI preservation program and the agency's efforts to support these valuable financial institutions. I want to thank my colleagues in CURE and in the Office of the General Counsel who assisted in developing the proposed amendments. Thank you for the opportunity to present the proposed changes. I yield the microphone back to you, Chairman Harper, to answer questions you might have.
Thank you so much, Pam, for your presentation, for your work on these important issues, and for your work on this policy statement that we're considering here today. Pam, I think you know just how passionate I am about what MDIs are and can do in the communities that they serve. That's why I think it's all the more important that it's June and we are recognizing Minority Depository Institutions Awareness Month, and it's the perfect time for us here today to be taking and considering this proposed change to the policy statement. Congress created the credit union system to meet the credit and saving needs of credit union members, especially people of modest means. Providing under-resourced households with access to financial services is not only a statutory requirement, it's also a moral imperative. And an essential component to achieving that statutory mission is the work of Minority Depository Institutions, or MDI credit unions for short. For millions of Americans, the work of MDI credit unions means under-resourced communities have access to safe, fair, and affordable financial products and services. That, in turn, leads to a chance to build a better and more secure financial future for themselves and their families. And having a stable and vibrant financial system that serves the financial needs of all Americans strengthens our nation and economy. As such, supporting and preserving MDI credit unions is a fundamental responsibility for the NCUA. Today, we are proposing to amend Interpretive Ruling and Policy Statement 13-1 to reflect changes in the agency structure and administration of our MDI preservation efforts by the Office of Credit Union Resources and Expansion. The revised policy statement, as you noted, would also improve the preservation program by simplifying the definition of communities it serves as designated in its charter to refer to an MDI's credit union's field of membership. For the last several years, though, I've had additional concerns about the process used during the NCUA assisted merger or liquidation of an MDI credit union. Under this revised policy statement, in the event of a potential failure of an MDI, the agency would contact MDI credit unions in the NCUA's merger registry, which qualified to bid on a particular failing institution to measure their interest. Agency staff would then offer technical assistance to any MDI credit union desiring to bid, in addition to providing MDI credit unions with an additional 2 weeks to submit a bid whenever possible. Together, these changes would not only bring the NCUA emergency merger process in line with that of the FDIC, but it would also increase the likelihood of preserving the character of the merged out MDI credit union. I've asked for the adoption of this modification in the agency's merger policy for several years. So, Pam, I am very, very, very pleased to see it here today in this proposal. Today's action, as you noted, Pam, also isn't the only effort of the NCUA to support MDIs. Last year, the agency launched the Small Credit Union and MDI Support Program. The most common areas of field assistance delivered to MDIs under this program were for examinations, staff training, and improving earnings in a rising interest rate environment. In 2022, 136 credit unions participated in these assistance efforts, and we've dedicated 5,500 hours to the regions to assist more MDI credit unions this year. And the agency has recently changed the way it's examined MDI credit unions to more closely match the practices of other federal banking regulators. For years, the NCUA has compared an MDI credit union to non-MDI credit unions. in its peer metrics. This is an apples to oranges comparison. The unique business models of MDIs often allow for higher expenses and higher delinquencies and higher staffing compared to other federally insured institutions. Plus, the imbalance created by measuring MDIs with peer metrics intended for non-MDIs could have a negative effect on the MDI credit union's operations and development. So to give MDI credit unions a more constructive basis for comparison, the NCUA this year began using new examination procedures that measure an MDI credit union's performance against other MDI credit unions. These apples to apples comparisons are tailored to the unique business models of MDIs and represent an essential evolution of the examination process. What's more, these changes will allow MDI credit unions to focus more time on serving their members rather than answering examiner questions. The NCUA has also laid out plans for its MDI preservation activities in the future. One step's already been completed. Congress added the MDI designation as an eligibility category for the 2023 Community Development Revolving Loan Fund funding at the agency's request. We will also host another MDI symposium in the fall, continuing a practice begun by Board Member Hood. There are other measures in the works too, which is the focus of my only question for you today, Pam. Would you please describe the types of engagement the NCUA plans with stakeholders to support groups interested in applying for a new federal charter with an MDI designation or aiding an existing credit union interested in receiving the MDI designation?
I'd be happy to. With respect to supporting groups interested in applying for a new charter with an MDI designation, CURE provides information about MDIs to prospective new charter groups in the new Federal Credit Union Charter Application Guide and directly to charter groups as they put together their application, specifically the business plan. In phase 1 of the chartering process, CURE staff ask if the group will have minority members, and if so, which minority categories. With this information, we can have meaningful dialogue about the benefits of the MDI designation. Our new charter coordinators talk to organizers early in the process, so MDI-related plans can be incorporated into the business plan. Also, when a group is chartered, they are provided with information on how to self-designate as an MDI. If a group qualifies, the coordinator typically follows up to ensure it self-designates on the first call report the new credit union files, so it can take advantage of the benefits the designation affords. Several recent charters have certified as an MDI shortly after chartering. Over the last 12 credit unions chartered, 7 have designated as an MDI. As far as aiding existing credit unions interested in receiving the MDI designation, Chairman Harper, CURE appreciates that you declared this month to be MDI Awareness Month. Using the agency's social media and direct contact with MDIs, we've sought to educate the industry on the designation and highlight the exceptional work and impact of MDI credit unions serving their communities. We hope the campaign will encourage eligible credit unions to self-designate, which has been part of the education we've been providing. A credit union interested in more information about the designation should contact CURE by email at curemdi@ncua.gov. Thank you, Chairman Harper, for allowing me to speak about MDI Awareness Month.
Okay.
I yield the microphone back to you.
Thank you for the idea of MDI Awareness Month. We must give credit where credit is due. And thank you for that response, Pam. I'm pleased that the NCUA is taking a holistic approach to identifying and supporting MDI designations and new MDI credit unions. When I meet with groups, I often talk about that MDI church credit union that's open for 4 hours on a Sunday, that AME congregation. I mean, they maybe, they maybe have 300 members of that credit union, but they're making $4,000 loans to Betty, who needed a new roof, or Ralph, who ran into problems with his car. Those are character loans often, and we don't want to see that disappear from the system, because that's really part of what makes credit unions and the magic of credit unions work. Promoting service and opportunity and financial security for their members are fundamental to the work of MDI credit unions. In fact, their existence means that an entrepreneur who other financial institutions might have overlooked gets the loan needed to start a business and to build wealth for her family. It also means a young couple who lives in an under-resourced neighborhood can begin saving for a new home, a rainy day fund, or their child's college education. In closing, the proposed changes to our MDI preservation policy statement would enable hundreds of MDIs to continue meeting the needs of their members and communities. This, in turn, would help millions of Americans increase their financial security and opportunity. And, as I said earlier, expanding access to safe, fair, and affordable financial services through MDI credit unions is good for our economy and it's good for our democracy. I strongly, strongly, strongly support this proposal. That concludes my remarks, and I now recognize the Vice Chairman.
Thank you, sir, and thank you, Pam, for the presentation. I think it's kind of remarkable. America has about the same number of credit unions as it does banks. There's 4,000 and change of both. When it comes to MDIs, there appear to be 4 times as many credit unions that qualify as MDIs. The data I've been given, at least, is about 500 credit union MDIs versus about 125 bank MDIs, right? That's something different. Now, that could be a function of size, and that credit unions tend to be smaller than banks, and MDIs tend to be small. Or perhaps it's the nature of field of membership and affinity groups. That's who sets up a credit union to start with. Either way, it's important that any credit union, any group that succeeds in forming a credit union has every opportunity to keep that credit union alive as long as feasible. If a given field of membership wants their own separate financial institution, an agency that cares about inclusion should take every appropriate step to allow that group to keep their institution alive. That means the NCUA shouldn't push for credit union mergers unless it's absolutely necessary. That means NCUA should have internal accountability around our charting process. We just discussed that. And I think it's important to know when these go away, it's very hard to get them back. The work that somebody did to charter is gone. I mean, I was up in New York. You mentioned AMA. I think Rodney mentioned the Native American Credit Union. I was up in New York. The Actors Credit Union, didn't even know it was there, actually. Broadway actors, right there in the theater district. Talk about a niche. Not entertainment, not actors, stage actors only. Went to their headquarters. They've also, it's an incredibly useful place, again, right there in the theater district in Times Square. The Actors Union's got a booth right there, so you can also do your union business, pay your dues. It's in a building where they have auditions in the same building. There was an audition there while I was there. And they understand those needs. Like, these are people who may have 19 different W-2s from the prior year, because that's how stage is. Exactly. And they want to get a car loan. That the credit union also knew that, Broadway went dark for a long time under COVID, right? It's one of the strengths of America in general that we have all these types of institution niche. If that Actors Credit Union, just use one example, or the AMA, or the one on the Native American reservation, that goes away. It's going to be very hard to get back. Yeah, they can merge, and your direct deposit will still hit. You'll have a checking account, but it's not the same. So that's why it's so important to keep these alive wherever possible. And I would say no institution should be too big to fail. They also shouldn't be too small to succeed. Today's item touches on ways to help a group continue to have their own financial cooperative. Somebody at some point in the past put a lot of effort in to start that new credit union, and this board item speaks to resources to keep those credit unions alive and thriving. One issue I want to address, just one question, is how we can make credit union management comfortable asking for assistance from the same agency, in fact, from the same field office, from the same examiners, that then examines them and grades management's ability, right? We grade, in the CAMELS rating, I think we agree the most important one is the M, management. Everything else is downstream of that. And we grade them 1 through 5. You then have to go to that same examiner and say, we need help with something. We might not have to do something. We're unclear how to. We might have even done it wrong. We need help. How do we make them comfortable asking for this help without reflecting poorly at exam time?
Vice Chairman Hartman, that's a really excellent question, and it's an excellent point you raised. Under the small credit union MDI support program, that's designed to be the help that credit unions really need, especially the ones that MDIs. But just as MDIs are not all alike, you each have given different examples. The program that provides that assistance has to also provide it in a variety of areas and through a variety of means. Fortunately, that program started last year, does provide assistance in areas such as succession planning, which is critical to small MDIs and MDIs, period. Net worth restoration planning, if that's needed. Mentoring, which is huge for small credit unions. And field of membership expansion, which is also key for a MDI to be able to grow. This assistance and the hours provided are through exam resources are done outside of the examination, and it's considered additional support. So it should not be that a credit union feels uncomfortable getting that additional support. Often the examiners are already aware that those supports and challenges exist. The examiners tend to also, because they're working more closely and directly with a credit union's management and board, they also tend to understand what those weaknesses and challenges are. And we hope that through this program, it provides the examiners the time that they need to give that additional support. The assistance is intended to provide participating credit unions extra support and encouragement. And this is something that MDIs have told us that they'd like to receive from the NCUA.
Gotcha. I hear they should be comfortable. I think we can all pledge to make sure that they feel that way as well. Because when you have a make or break exam, it's stressful like anything. I don't know if you've ever been through like an IRS audit, but you don't volunteer anything new to them. You don't say, hey, how about this deduction I wasn't sure about, right? You want it over with. You don't volunteer anything you're unsure about, right? Because you want it done and over with and you want to pass. So I appreciate your pledge to make sure we'll do everything we can to make sure that it never reflects badly. People asking for help is good. That's good management. And it's not going to reflect poorly when those same humans come in to rate the management. All right. Thank you for your work. Back to Chairman Harper.
Thank you so much. Board Member Hood, you're recognized.
Great. Thank you, Mr. Chairman, and thank you, Pamela, for that very insightful presentation. And I must tell you, I got up this morning really excited about supporting today's IRBs because it's so important that we have strong, healthy MDIs in our country. However, the overall trend toward consolidation and growth in financial institutions and the loss of diversity within the financial services system has not necessarily been beneficial for consumers and local communities. I don't want to see further contraction in the number of smaller and mid-sized institutions, and that includes MDIs and CDFIs, which is why I believe we need to be talking about ways to shore up and protect smaller financial services providers. I'm delighted that we currently have about 523 MDI credit unions, which I believe is almost 3 or 4 times the number of MDI banks. And again, today's board action is a step in the right direction. Now, to be clear, I'm not talking simply about propping up weak institutions just for the sake of propping them up. After all, I'm a strong believer in the free market system, but a healthy financial ecosystem needs smaller institutions, particularly if our goal is financial inclusion and extending access to financial services more broadly to underserved communities. From that perspective, the trend toward consolidation in ever larger financial institutions is worrisome because it runs the risk of taking us further from that full goal of financial inclusion. In talking about large institutions, I should pause here to make something clear. I certainly don't intend this as a critique of the larger financial institutions. They serve an important role in the financial ecosystem as well, and thanks to their economies of scale, they're able to do things that smaller institutions cannot do and frankly should not do in some instances. So I'm not at all hostile toward large financial institutions. After all, I've worked for many of them in my own career. So the question is, how do we best, though, ensure that smaller and mid-sized financial providers, such as MDIs, flourish in this challenging environment? First, from a policy-making standpoint, it's worth noting that regulators and lawmakers need to be focusing on the moves we can make to shore up small institutions so they can compete effectively and flourish, and to help them maintain their position within the financial services ecosystem. Many of you are fully aware, I believe, that this has been a priority of mine as a regulator, that we help our small institutions, that we support MDIs, and also, while doing so, still adhere to my belief that regulation needs to be effective without being excessive. And again, I'm not saying we need to protect every small and medium-sized institution at all costs, irrespective of performance. But I do try to be attuned to ways to address the regulatory burden that gives federally insured credit unions in the United States the flexibility they need to compete in a very challenging and dynamic marketplace. Chairman Harper has been a leader here, and again, designating MDI June as MDI Awareness Month. MDI credit unions, by virtue of serving an underserved population, need to be examined differently because, quite frankly, a one-size-fits-all approach doesn't work. Under the chairman's leadership, the NCUA is making the right moves. Again, this is by virtue of serving underserved members. We need to be looking at things differently, so we will be doing so in our examination program. We're also encouraging credit unions to explore and embrace the world of financial technology. I used to argue that fintech was the future of financial services, but I've stopped saying that because we've reached the point where the fintech is the present of financial services. I don't think that anything says it better than our board's support of financial technology, and that is through the creation of our Financial Technology and Access Office run by Charles Weiss on the financial technology piece and Natasha McAdoo on the access piece. So I'm delighted that we as a board have been able to put those resources out there. And I do think that those types of tools that we are implementing are tools that can be a great boon for our smaller institutions if they are in fact approached with prudence and care. And they can make a huge impact in terms of helping us reach underserved communities, particularly younger consumers and the 26 million credit invisible households and the nearly 40% of households still to this day unable to obtain $400 in the event of a family emergency. So I encourage healthy experimentation with fintech. I would emphasize that if we truly care about financial inclusion, as we all do in this room, then we must recognize the importance of smaller institutions, again, in that financial ecosystem. In my job overseeing some 4,800 credit unions, I see examples of this important work each and every day. I could point you all to North Little Rock, Arkansas, where the NCUA approved a new charter last year for the People Trust Credit Union. This is a minority-led institution founded by a gentleman who started his career as a barber and later went on to establish a barber college to serve his local community. Recognizing the needs of his students and their families, he launched a nonprofit loan fund to provide people in the community with loans to build up their credit scores. Then he took the leap of launching a credit union to provide a full array of financial services. This is a remarkable story of someone seeing a need in the community and taking the action to create opportunities for others, which is, I think, something that we're going to see from the earlier board briefing we had on the new chartering process and today to what we're doing to preserve our MDIs. I do have a few questions, though, in addition to my great support. Can you talk a little bit about the staff hours that are being allocated to working for small credit unions and MDIs? What are we doing to help preserve them in terms of the staff hours?
Absolutely. Thank you for that question. So the support program annually requires each region to identify specific credit unions that will receive additional assistance through the support program and budget for those hours accordingly. In 2022, the types of activities appropriate for this program included providing credit union personnel with assistance or guidance in areas such as discussing NCUA and third-party resources available to small credit unions and MDIs, and how to obtain assistance from those entities, applying for grants, reviewing the NCUA training materials, including those available through the Office of Credit Union Resources and Expansion, assisting MDIs to address exam concerns, and the agency is currently meeting the performance plan indicator to date. Field staff are made aware of the available hours and offer to credit unions assistance under that program.
Great, thank you, Pam. And something that I've been emphasizing as I've been out on the road speaking with credit unions, and that is the grants that we're making available. I think the industry has long known that we've supported the grants for our CDFIs and our LIQ, so this is new that we are now making those same grant dollars available for our MDIs. So could you talk a little bit about this and how we're supporting the mentoring grants, financial assistance? Because again, the industry needs to know this is new, that those dollars can now be deployed for MDIs.
Yes, and again, thank you for this question, Board Member Hood. For the first time this year, grants are explicitly offered to credit unions based on their MDI designation. And so the current funding round ends a week from Friday. It's still not too late for credit unions who are seeking financial assistance in their own right as an MDI to apply for the CDRLF, the Community Development Revolving Loan Fund grants, under the program that's being offered this year for the first time.
That is a great move, and thank you. And I know the chairman mentioned a bit of this, and I just want to have this reiterated for the record, and that is, how do we consider MDIs during the merger process? I know the FDIC has a similar program in place.
Right. So one of the objectives of the support program is to provide support and improve the outcomes for credit unions, resulting hopefully in fewer failures and mergers, and expanded access to safe, fair, and affordable financial services to persons of modest means. Under the proposed IRFs, the NCUA will attempt to preserve the minority character of a failing MDI during the resolution process. In the event of the potential failure of an MDI, the agency will contact MDIs in the NCUA's merger registry that qualify to bid on a particular failing institution. Agency staff will solicit interest in bidding on the failing MDI and offer technical assistance to any MDI desiring to bid. The NCUA will also provide MDIs interested in submitting a bid with an additional 2 weeks to submit a bid whenever possible. Except in the cases of conservatorships, liquidations, or assisted mergers, the MDI's board of directors is generally the decision maker on a merger partner, provided the selection is consistent with regulatory and safety and soundness standards. For conservatorships, liquidations, or assisted mergers, in the selection process, the NCUA will consider all the requirements applicable to a merger or purchase and assumption, including FOREA's general preference guidelines.
Great, thank you, Pamela. That's really helpful. I was somewhat surprised during our briefing when I asked about the credit unions that are in Alaska and Hawaii, that not every credit union that's headquartered there is an MDI. So could you please discuss how are we including Native Alaskans and Hawaiians in today's action?
So thank you for that question. The proposed IRFs makes clear that Native Alaskans are included under the definition of Native American.
That works. Thank you very much. And this ties into the next question, and that is, I have a feeling that there are many more MDIs out there in the credit union space. Yes, we do have 523 today, but I just think that there are those that are not self-designating. What else can we do to encourage self-designation?
So we think that the designation of this month as MDI Awareness Month is key to that. During this month, CURE has had and will continue to educate credit unions and the industry about the MDI designation and highlight the significant contributions of MDI, ensuring an equitable and financial services industry. We hope these messages will encourage credit unions that qualify to self-designate as an MDI. And finally, the NCUA will host an MDI symposium in October 3 and 4, here in the central office, the goal of which is to foster greater support for MDIs by developing an industry-driven plan to bolster them.
Great, thank you. And I am, again, excited about the hard work you've done. Thank you for it. And I have no further questions or comments, Mr. Chairman. I yield back the floor to you.
Thank you so much, Board Member Hood. And just building on your comments about the grants and loans provided through the Community Development Revolving Loan Fund. Pam, you said the deadline is June 30th, next Friday. And this year, it's really important to note that Congress more than doubled the amount of money.
Exactly.
So we are able to make more grants and bigger grants. And those grants are going to be things like $10,000 for cybersecurity and digital services. That's huge for a small credit union. Or training, which
Exactly.
is often one of the first lines that gets cut when the budget is tight. Or the mentoring grants. And I really, I've done personal outreach to many different groups and stakeholders, encourage them to come forward with those mentoring grants because they really do make a difference. And I think this year, the Small Credit Union Cooperative Grant, where we're going to allow small credit unions to come together, get $50,000 and use it for productive purposes that serves all of their needs. Just one last question though, Pam. Where do credit unions go to find this money and to find this grant application?
Thank you very much for that. The NCUA website, under support services,
Yeah.
credit union resources and expansion, and grants and loans programs. You will find a grants and loan page where you, the link to the application, as well as all of the information about the various initiatives for this year will be found. Again, the deadline is a week from next Friday.
Yeah. Pam, let's make it easy for people. You said it was pretty straightforward. Go to our support services, go to Credit Union Resources and Expansion, go to Grants and Loans. But how about we work with our Office of External Affairs and Communications and put something right there on the NCUA main page for this last week so that people can find it?
That sounds awesome.
Great. All righty. Board Member Hood, is there a motion?
Yes, Mr. Chairman, I move that the board approve proposed interpretive ruling and policy statement 13-1 for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show the motion passed 3-0. Thank you so much, Pam.
Thank you.
That is the end of our agenda today. I want to wish everyone a safe and enjoyable Independence Day in the weeks ahead. We will see everyone at our next board meeting on July 20th. There being no further business, we are hereby adjourned.